Hi, everyone. I'm David, and I'm excited to introduce Mike Bernstein, one of the owners of Bernstein Financial Services, along with Rachel Garcia and Anna Wingstein. With over 35 years of experience, Mike specializes in helping businesses and individuals, both in their personal and business financial futures. He's also the author of The Ultimate Guide to Planning Your Personal Finances and a triathlete. Take it away, Mike.
Hello, everybody. Great to be here tonight. Thanks for sharing some of your evening with me. A few housekeeping items for maybe 5 minutes or less. Then we're going to go into the content for about 25 minutes, 25 minutes, and then there'll be time for questions. If a question is really burning, put it up there. Anna may say, hey, Mike, answer it now. In any case, I can't see or hear any of you, although I have a list of who signed up. And so without your comments, we won't know what you're thinking. I can't hear you laugh. I can't hear you cry, whatever it is. So anyways, so you know that. And about half of you are clients of Bernstein Financial already. And about half of you come in from our LinkedIn contacts that are not our clients who don't know me, except for tonight. Okay, so let's get going with the intro, the rest of the intro. And that is, hey, listen, all of you have different situations. And this is the third webinar in a series of 3 webinars that cover this planning information. The first webinar was for people starting out, say 20s or 30s. The second one was for 40s, 50s, maybe early 60s, or 30s, 40s, 50s, the mid-range. And now it's closer to retirement. And all the information is technically the same. I cover all the big 6 we talk about, but I put emphasis on different areas. And obviously the emphasis here will be on the later years like retirement. So we'll do that. Second, I can't address each one of your situation. They're all going to be different. Some people have enough money where they can retire today and they're not even 60. Other people don't have enough to retire. They might be 75, but they have other questions going on. So, I'm going to go over general items and guidance, and you'll take from what you can. You might need to make a separate appointment with me or ask separate questions through an email to get something about your specific situation. Okay, but hopefully, even if you've done a lot of planning and you know a lot of things I'm going to say, hopefully you'll get a few nuggets out of it, or to remind you to do a couple things. Okay. Next, I wanted to mention that it's the Big 6. I said it earlier. And the Big 6, David, could you bring up the book? Yeah, the Big 6. There you go. Bring up the Big 6. Perfect. Those are the 6 that I cover: cash flow, insurance, retirement, college planning, estate planning, and tax planning. So we'll be coming not necessarily in that order. And some, again, are more emphasis than the others that I'll spend time on. The book, could you bring up the book? There you go. There's the book. It's about 80 pages long. It covers what I'm going to cover tonight, but a little bit more in depth. It's maybe 10, 12 pages per chapter, easy reading. Sounds like I'm talking to you. So a copy of this book, a digital copy, is going to be sent to everybody attending and signed up for this webinar. So know that you'll get this anyways. And this brings me back to, I don't want you to take too many notes and not listen to what I'm saying, because I'll be talking fast in order to not make the webinar too long. I want to be done in 25 minutes. In any case, you can always listen to the webinar again because it'll be posted, or you can get the book, read the book, and you'll get information about this. All righty. Next, I wanted to mention that this is not revolutionary information I'm telling you. It's been out there. You can find it in other people talking about it. What is revolutionary is an accountant talking about it, because I find that it's not a income generator for most of my industry fellows, and so they don't want to spend time on it. But I think it's so important not to just do someone's taxes, but to try and prepare them to navigate life financially and successfully economically. Okay. Okay, I think we're ready to start. So I'm going to do them in this order: cash flow planning first, and then insurance planning, then estate planning, retirement planning, college planning, tax planning. All right, let's start with cash flow planning. David, could you please bring up the P&L portion of the cash flow planning? Some of you may have seen it from me, but I created this financial. It's the next page over. There you go. Has income and expenses. In order to know what you can afford, even to know how you can retire, I say everyone should be filling out this from young to old. It's not easy to do. At the top section, you put your net income from working for wages or self-employment or pension or wherever you're receiving your revenue. And the bottom section is even more important, and that's what your expenses are. People don't like to list down their expenses. Sometimes they don't like that result. What's important when you list down these expenses is that you do everything monthly. Could you go to the instructions, please? If you follow the instructions that David puts up here, it basically says, don't over worry about this whole sheet. Don't spend too long on it, but also make it monthly. Go to this P&L again, please. What monthly means, if you pay property tax twice a year, you add them up and divide by 12 and put in 1/12 under each month. If you pay for insurance over 9 months for the car, you add up 12, you add it up for the year, divide by 12, put in 1 month. Now, do that with everything. So you normalize it to a monthly cost, and you know whether your income every month is covering it. Second, don't leave out things like vacations, groceries, cash you take out every week to maybe go to lunches and things like that. List them all down in any order you want. Try to get everything in there. If you're not sure about it, look back to the last couple of months, your bank statements. You'll find out very quickly what you're spending. The last thing I want to say about this sheet is don't make it what you want it to be. Make it what it is historically, on average, the last several months, the last 6 months, because anyone can make this what they want it to be. But you first have to know where you're at to know whether you're negative or positive and how much, so you can make changes and make it what it needs to be. Okay, and there's one, for example, filled in. Okay, so you're going to be using this throughout your life, and now near the retirement ages, to figure out what your retirement expenses are also. Go ahead and go to the third page, the assets and liabilities. This one shows, the top section shows what your assets are. So what's in your checking, savings, 401k, IRA, house value, rental house value, whatever the things you have, partnerships. And the bottom section shows the debt, whether it's consumer debt, and you can expand it to add all the things you have, home loan, car loans, and you get a net equity at the bottom. Then you kind of forecast where you want it to be at the time you want to retire. And then the far right, we figure out how much income you're going to have from that to determine whether it's going to cover your anticipated expenses that you've listed on the other sheet. Okay, so that's enough on the cash flow. We're going to refer back to the cash flow when we get to retirement section. I'm going to now move over to insurance planning. You can move off of this. Thanks so much. That's what I will be talking about, right? Okay, so we're talking about, take this off for a moment. We're going to bring it right back up, David, in a minute. They can look at me talking for a moment. There you go. Okay, insurance planning. We know we need health insurance. You need health insurance your entire life. Disability insurance, really, it's running out now. If you're close to retirement, 65, you're not going to have disability insurance anymore. What I want to talk about is life insurance and long-term care. Those are the two main ones as you get older. First of all, do you need life insurance? How much life insurance do you need? Well, that's what this graph is about that he's going to bring up. The older you get, the question is, do you still need life insurance? Well, one would hope as you get older and you put away money for retirement, you'll accumulate equity. And in equity builds up, you might accumulate 500,000, a million, 2 million, 3 million in equity. Well, the more equity you get, the less life insurance you need to fund a possible early death. Okay. David, you can bring up that graph. Any case, early in life, as the graph shows, when you're younger, you can see the gold. When you're younger, you can see if you look up, the insurance needs are very high because you haven't accumulated that equity. As you grow older and you accumulate equity, then you don't need the insurance, and that works out fine. Now, if you haven't accumulated enough equity, should someone pass away, then you want to retain some insurance to fund that for your loved ones. It won't fund it for you if you both live, but is there to fund who needs to be taken care of. You can take it off now, David. The other type of insurance, and this is not about which insurance you can get. You can talk to me later about that, whether it should be term, permanent, how long it should be. We do know if we have some health problems, it's very expensive to get insurance, life insurance late in life. Okay. Long-term care. Some of you may have it, some don't. Some may be wealthy enough that they can fund any long-term problems they have health-wise. If they have to be in a home or nursing care, eventually it'll do it. And then those who have very little retirement saved will probably be covered by Medi-Cal eventually. It's the people that are in the mid-range that ends up using all their money because they don't have a long-term care policy. So if you don't have one, you should look into one. And it doesn't have to be all or nothing. It doesn't have to pay $20,000 a month. It could be something that pays $7,000, $6,000, $7,000, $8,000, costs a little bit less, but still covers a portion of nursing care so that the rest of your assets can cover the rest. So you should look into long-term care. I've had long-term care for a long time, and I think it's important to have it if you can get it. If you have some health problems, you probably won't be approved. It'll be very expensive and most people will try and get it normally in their late 50s or early 60s if they don't have too many health problems, and sometimes a little bit later. I got it at 43, but as some of you know, I like doing triathlons. I figure one of these days it's going to bonk my head and I'll need it early. Luckily, I haven't. Luckily for the insurance companies, I've gotten the premiums all those years and I still have it. Okay, we're going to move off insurance because that's not the most important thing. We're going to get to some of the most important things for you. Number 3 is estate planning. Okay, probably everyone watching this should have an estate plan. And by estate plan, I'm talking about a trust, a living, revocable living trust. Mike, I only have a house and money in my IRA and 401k. Do I really need to have a trust? Well, it's not just, there's a lot more to it than, hey, I have a lot of money, wealth, because actually most people will not pay inheritance tax on their assets right now. If you got to be over 30 million as a couple, 15 million single when you die to have an inheritance tax. So that's not the majority of all of us or my clients. Okay, a very smaller minority. So in this case, what does it do for me if it doesn't save taxes? Well, what it does is it provides care availability and use of assets and direction of assets. So let me explain this. So if I do that triathlon and I fall, bonk my head, and I'm out for a while, and I mean months or years, besides long-term care, funding my care, who takes care of me? Who makes those decisions? I can't. Well, if I don't have any legal documents, well, a spouse, hopefully. But what if a spouse disagrees with a child who says I should have a different care? Can it become a court case? Yes, it can, and there are cases like that. But if you have a trust that says, if you have a problem, if I have a problem, I want so-and-so to be my trustee for healthcare, they will be the trustee. If they can't or don't want to act, there's a successor. Okay. So it says who's going to take care of me. I can also have that person, control the assets to be able to pay for that expense. So they will be able to pay for the bills, not only just say where I should be and how the care should happen, but how it should be paid for. So it's the use of the assets is to provide care. And then the direction of assets is really, okay, I was incapacitated, then I died. Well, the trust will direct the assets. And you can use the state law, that means you have no trust, no direction, no will, no nothing. But state law, they have a program for you, and it's very strict. You can't change it. So it's going to go spouse, I believe that it goes children, then parents, then cousins. I forget the order, but you can't divvy it up the way you want. So a trust will allow you to direct your assets the way you want them. So pretty much everyone should be having a trust. It also has no court involvement because the legal document says what's going to happen, and the court doesn't have to approve care like a living probate. Okay. All right, good. So I'm not a lawyer. I'm not saying that if you don't have a trust, it's a bad legal thing. It's my opinion, but I've been involved. My father was a estate planning attorney. My brother Dave is a estate planning attorney. Been around a lot of trusts. I have a trust. I've had one for a long time. I think it's a good thing to do, and they're revocable. You can change them while you're alive and well. Okay, let's go to number 4. And where David's going to watch my time to make sure we finish up this around 6:25, 6:30, so we can have questions. I'm not watching the questions because I'm concentrating on my notes here to tell you everything I need to know. So Anna and David are going to be looking at the questions, and they're going to let me know at the end or in the middle if we need to. All right. Next, retirement planning. And this is the biggie, of course. The cash flow is used for this. The first thing you need to do at retirement planning is to know what your expenses are going to be. As you get closer to retirement, you get a very good idea of where you're going to be. Am I going to be at the same house? Do I want to retire to another state? Do I want to retire right where I'm at? Do I want to travel a lot? What are my expenses going to be? So you can use the cash flow financial statement to determine. You can do a second one for now, one for when you retire. Some things might change a little bit. And let's say you determine your expenses at retirement are $8,000 a month. Okay. Or maybe they're 10, or maybe they're 50, whatever the number is, you figure it out. Then you got to decide your goals at retirement. In other words, is my goal to stay here? Is my goal to buy a bigger house or a different house or a second house or rent out this one and buy a vacation? You got to set your goals so you can set those expenses correctly. Okay, once you've determined those expenses, and don't forget the fun in doing your planning. In other words, if you're going to do a lot of traveling, you might want to put $1,000 a month in, $12,000 a year for travel. Maybe more, maybe less, depends. Or maybe you want to buy some special sports car when you retire, do it. But anyways, put it all in there, otherwise it won't work. Okay. So once you've got your expenses, now you got to decide how much income you need in order to pay those expenses. And you can just use about an 80% rule, approximately, somewhere around that, because you have some taxes. So if I need 8,000, I need to earn about 10. That's a good start. You can get more specific with a person like me on a meeting to figure out the tax liability at retirement. So let's do an example. Let's say you're bringing in $7,000 a month, you and your spouse, from pension and Social Security. And let's say you have $500,000 invested, and if you wanted to take some money out of that, but you don't want to touch the principal, 5%. Let's say you could do five. Let's say it's $1 million, not a 500. It's an easier number for you to put your head around. $1 million at 5% is $50,000. That's approximately $4,000 a month. So $4,000 a month plus the 7 from your pension is $11,000. $11,000 is going to turn into about $9,500 or $9,000 net. Okay, so there you go. If your expenses are 12 and you're only bringing in $9,500 after tax, you're going to dig into the principal, and eventually it's going to run out. So this is the roll up your sleeves, figure out the numbers way to do it. Now, I said 5%. Should you use 5? Should you use 6? Should you use 4? Well, most advisors, you may or may not have a financial advisor, most advisors kind of land around the 5% number. If you want to be conservative, use 4%. If you don't take more than 4% from your money out there invested in the market in different places, then you'll probably not dig into principal. If you start taking 6 and 7 and 8% per year because you need it to live on, then you're probably going to dig into principal. Not necessarily. There's a lot of good years, in the market or where you have invested, but that's a rule of thumb. So now you're going to take that income. You can do another sheet like I have there with the P&L. You're going to put in the income. You're going to put in the retirement expenses, and you're going to see how it turns out. And if it doesn't turn out good, don't despair. We make adjustments. What adjustments can you make? So I own a home. Maybe it's paid off, or hopefully it's mostly paid off. And what can I do? I could sell that home. I could buy a smaller home or a less expensive home, either where I live around or somewhere else. Take the extra couple $100,000 or $300,000 or $400,000 I might get from it by buying down, invest that, add that 5% to the rest, see if it works out. See, Mike, but I don't want to sell my home. I want to live in this one. You know how many times I've heard that? said, well, sometimes the circles don't intersect. So when you get to retirement, you need to know that might be an option to be able to meet your needs, or maybe you have to lower your expenses. Can't travel 1,000 a month. Maybe you have to go to 500 or 250. What's more important to you? A lot of it revolves around what's important to you and what you're willing to sacrifice and give up. Okay, that's important too. Okay. All right. Anna, pipe right up if there's a question that's really germane to what I'm talking about. Okay. And I can't say enough to include fun in your retirement program, money-wise, because there's going to be a day that you are not feeling well enough to have fun, and you need to put that in there now and do it when you retire, as opposed to kind of save your pennies if you don't have to. There's two other areas I want to talk about, and they're not specific to really succeeding right now. The first four were college planning and tax planning. College planning, the ages you all folks should be at right now attending this, your kids are either in college or through college. But they are going to have kids, and maybe you have older kids that already have kids. So if you want to do some college planning, start for your grandkids. As soon as they're born, create a 529 plan, start putting in 2, 3, 4, 5,000 a year. Start out small, build it up. Whatever you put in is going to help them. And that's going to help when they add money to the college planning to invest for later on. And as the grandkids get more and more, you separate accounts for each one of them, and you add. So that's how you plan for the college planning for your grandkids. As far as tax planning, by the way, there's other ways to do. There's education IRAs in addition to 529 plans. And also, I want to let you know that you can actually do a UGMA or UTMA account, Uniform Gift to Minors Act. You can actually create an account for them with their Social Security number, and you put the money in there. Much more flexible, doesn't have to be used just for college planning. And the bad part of that one is that once they're 18 or 21, it's their money. And that may not be the plan you want to happen, because they may not use it for the thing that you want them to use it for. Okay, number 6, tax planning. Okay, well, you would think this would be the biggest section. I'm the tax guy, but it isn't, not right now. Yes, when you decide your retirement plan, you want to be efficient on your tax planning if you can, but those other areas are much more important over the long term for planning for your retirement. So when you're doing the tax planning, let's say you have half of your money in an after-tax investment and half in a pre-tax investment. Pre-tax is like traditional IRAs, 401ks, things like that. After-tax is a regular investment account with Merrill Lynch, Morgan Stanley, something like that. So if you take money from the after-tax account, there's a lot less tax burden than if you take it from the pre-tax account, which there's a tax burden on everything you take out. So some people come to me and they say, I've got $2 million in my 401k, but I've only got $50,000 in savings, and I'm going to have some Social Security and pension. So, okay, it looks like you're going to be fine, but every dollar you take out of that pension plan is going to pay tax on it. So you got to take a lot more to fund it. And they get upset because their taxes are so high along the way. I said, don't forget, you save taxes all that time on putting it into that pre-tax account, and that's why you did it. So most people I talk to along the way, if they ask me, I encourage them to put kind of half and half so they can manage their tax burden a little bit later on. They take a little bit from the pre-tax, a little bit from the post-tax, and it manages their tax burden a little bit better. So if you're young enough to try and reconcile that a little bit, do it. If it's not the case and you're already at retirement, there's not much you can do about that. There is something little. We'll talk about it a little bit. And that's a conversion to a Roth. All right. So what you want to do is once you're ready to retire and you've got your plan, you check with the tax person like me, and you say, okay, how much tax is going to be on this? If I bring in 14, am I going to really be left with 12? And that'll fund my expenses or not. So that's the way you do your tax planning. I'm looking down at my notes to see if there's anything else I wanted to tell you about this. No, that was it. So I'll now discuss evening that up a little bit. So there's a conversion to Roth. So if you have a 401k or not a traditional IRA that has a lot of money in it because you maybe rolled it over from the 401k and you want after-tax money, you can actually take money out of your traditional IRA and roll it over to a Roth. It's going to be taxable because you're taking it out of a traditional IRA. But once you put it in the Roth, roll it over, the Roth is never taxable and none of the earnings are ever taxable. So it has a good chance to earn tax-free dollars for a long time. So some people, if they've got $2 million in their IRA, they might move over 400,000 or 500,000, take the tax hit all at once, leave the rest in there, let it grow tax-free, and that grows. And now they've got 4, 5, 600,000 in 5 years, 7 years to draw from there at tax-free and take out of their regular. I found that even people that plan to do it have a rough time doing it because paying that tax burden all at once is very, very difficult on the emotional psyche. Okay, so next, I just want to say a couple things before we go to questions, all right? And Anne's going to take those questions. She's going to come on and she's going to say the questions and I'm going to answer them. First of all, if the question is too specific to you, and I don't think it applies to the general group, actually, Anna will probably hold that for later and I'll answer it separately on the side at another time. If it's more general, then it'll be a good time to answer. Now, just because this webinar was good for you doesn't mean there isn't one's good for your kids and grandkids. So you may have grandkids in their 20s, tell them to watch my first webinar. Or if you have kids in your 30s and 40s, tell them to watch my second webinar. The sooner they watch this, the sooner they do the financial planning, the sooner they start saving for retirement on that spreadsheet, the sooner they're going to know if they're going to make their goals of where they want to be. Okay, that's number one. And then number two is that I want you to rewatch this if you've missed some of the things you need to see them. And also I want you to read the book. The book will not take long to read, believe me. Okay, so we'll go to Anna now. It's 6:25, so we've met our goal of not spending too much time on your evening here. Anna, you have a question for me?
Yes, I do. Hi, good evening, everyone. My name is Anna, and I have the privilege working with Mike for many years, although I'm only 25. Anyway, the first question, Mike, is it too late or even a good idea to do IRA to Roth conversion at 60 to 65 years, or when might be a good time?
Well, I would suppose it would depend on your life expectancy, right? So if you have good genes and you think you're going to live to your 80s, 60 to 65 is plenty early to roll to a Roth because you have 20 years of earnings, tax-free earnings going on. So if you have enough that you have a financial advisor, they have programs, software programs that will do modeling to see how much would be the best amount to move over. I'll say one other thing. I'll give you an example because there's some tax planning involved here. Let's say I'm going to retire in 1 year from now, and my wage, I won't have a wage. And I might have Social Security, or maybe I didn't start Social Security yet. I'd be 68, starting at 70. And maybe I don't have a regular monthly pension. I'm just going to take it from my investments. And so basically I'm going to have very little income. That's a perfect year to do the Roth rollover because you're using the low brackets. So timing of the Roth rollover is very important. Sometimes a very short window to get a bunch moved over. So you take 100,000, 200,000 a year and you move it over, you pay the tax on it, and you've started out your Roth. So
okay,
yes.
Great. Thank you, Mike. Second question it's a one question, but it kind of have a two parts. I'm going to read one part at a time. Should I pay off my house with investment funds? That's the first part of the question.
Okay.
Should I pay off my house with investment funds?
Okay. So let's say you have a house, you're nearing retirement, and you have a house, let's say worth $800,000, and there's a loan of $100,000 on it. And you have investment money, and there's three answers to this one. And those three answers are, there's an economic answer, there is a trick myself answer, and there's an emotional answer. So the economic answer is, how much am I paying on that mortgage? What percent? How much money do I have invested, and what percent am I earning there? And if I'm earning 5%, but this mortgage is at 6%, well, I should pay it off. Okay, that's an economic item because I can do better by paying off the mortgage. There's a trick myself method, and I think that's the best one, by the way. And that is, if it's $100,000, I take $100,000 of my investment. Let's say it's an after-tax investment, and I pay off the mortgage. I'm not going to have the mortgage. My cash flow is better, right? Your cash flow really didn't change between the two because you're earning on the money you invested. Maybe it changed a little bit. But what happened was, will you ever replace the $100,000? So the mortgage, let's say the mortgage was, $1,600 a month. So you're not paying the $1,600, but are you taking part of that $1,600 and putting it back in the investment account? No, people don't do that. They use the $1,600 and it never gets replaced. Whereas if you take out of your out of your cash flow every month, you can afford to pay that mortgage. You add a little bit to it and pay it down over time. You still have your 100,000 investment account and you pay down your mortgage. That's the same trick with credit cards. People pay them off, charge them up again, pay them off, charge them up, and they take it out of savings. It's a bad way to go. So anyways, that's what I think. And the last one is the emotional one, which might be the most important to you. And that is, what makes me sleep best at night? Mike, I don't care about that. I'll sleep better if I know I don't have a mortgage at retirement. Well, pay it off. That's the answer there. Okay.
And then the same question, should I pay off my car and the credit card? So you partially kind of answered.
It is exactly the same answer there. Sometimes it's a little bit easier to decide because the amounts are different. But I can tell you this, when you're paying off consumer debt, some people say just go to the highest interest one first. Well, generally that's correct. But I think the best method is you go down to the lowest balance first. And you pay off that balance, take that payment, add it to the next lowest balance you're paying off, and then pay off that, then add those two payments to the highest. And I believe that pays things off the fastest for most people because they can see movement, they get motivated, they hit goals rather than it taking forever, a lot longer actually to do it the other way because it just doesn't work as well. Okay, that's the credit card one. By the way, I saw in the questions, someone was asking, how can I move more than $8,000 into a Roth?
That's the second method.
When you do a Roth conversion, you can move as much as you want over in a year. Conversion. A Roth contribution, where you putting money into a Roth out of your own money, not a conversion from a pre-tax fund, that's limited to the IRA rules and an income limitation. It's a completely separate animal. So conversions, you can do as much as you want. IRS is happy for you to pay tax on it right away. Okay. Anything else?
Yes. If you have retirement savings and in an after-tax account, a traditional IRA and a Roth IRA, which order do you recommend taking from each account?
For some reason, people never want to touch their Roth ever. They want to leave it forever. Maybe because they don't want their kids to pay tax because the kids can get the Roth and they won't pay tax on that. But I think there should be a tax analysis of what's the most efficient tax-wise for you. So it might be a little from all three. I don't know. I have to see your tax return, see what's most efficient and the amounts in each one. And I would say there's some combination that I would recommend. That's the way I would do that.
Okay. Does it make sense to move to a tax advantageous state in retirement?
It might. Like Texas has zero income tax. Washington, I think, zero income tax, and Florida. But you have to look at more than just that. And I'll talk about the economic and then the non-economic. So I've had people move to the Midwest where it costs less to live, and the income tax might have been less too, but they couldn't stand the weather, so they had to move back. So consider that as well. But it depends on your income level, because Oregon and Arizona, for example, are a higher tax than California if your taxable income is less than about $70,000. Because what happens is California has a very slow uptick of tax. It's a very straight line like this, 1%, then 2%, then 3%. And a married couple under about 70, 80,000 pay very little state tax in California. Now, it does go up to 9, 10% in California for high income, 400, 500,000. But if you go to Oregon, it's a very steep 0 to 5%, and then it flattens out. So already at 30 per thousand, you're paying the 5%. So at lower levels of income, it definitely does not make sense to leave California for that purpose in this example. But then you also have to consider, like Texas, there's no income tax, but their property tax is higher. So you got to know what house you're going to have and look at the whole package of other taxes and cost of living. You can look up cost of living in cities and states and make sure you look at the whole package. And the last is the, care, health care, distance from family, cold or heat, and what you can stand and live with. Okay. So yes, it could be, might not be. Okay.
Thank you. ACA healthcare policies have become expensive. Are there other options to consider, or are we stuck until Medicare kicks in?
Well, interesting, because it's It's become very popular to talk about this, obviously, because everything in the news. And I don't know if it's going to get better before it gets worse. But probably the best answer, because I'm not a healthcare expert, is we can refer you to a healthcare person who can give you a better idea if there's a private option. I haven't found a lot of clients finding good private options. They might get a less expensive ACA, but then the benefits are not as good. And remember, with ACA, there's a lot of planning to be done to try and lower your income, because even though ACA may be high, if you get a big subsidy, it isn't high. But to get a big subsidy, your income has to be low. So there's a way to structure your assets and income such that you're not too high on the income side. You can draw money from certain places that don't cause income and don't cause a subsidy to be taken away. So I've worked with a couple of people trying to plan that. Because let's say they have a big traditional IRA and not a lot of money somewhere else. Mike, the only way you can live is taking out a traditional IRA. I said, what about borrowing from your house? I said, you think I should borrow from my house? I said, you're 63. You're going to be 65 in 2 years. What if we take a little bit from the IRA and borrow a little bit on a credit line for 2 years? And then afterwards, you can start taking it back and pay back. You tell me how much you're going to save on the medical by keeping your income low and lowering that ACA subsidy pullback, right? So there's not always answers, but there's some creative ways to look at it. Next.
If you are 69 and have money in a pension plan, is it beneficial to start taking some distribution from your pension before you are forced to take RMD distribution?
I don't think so. And RMD distributions start around 73 right now, generally. And the RMD, required minimum distribution, I hate people who use acronyms and don't explain it. That means the IRS says at 73, you have to start taking something. And they use your life expectancy. They know how long you're going to live, the IRS. If you ever want to know, just look it up in the chart. And they use that. They divide that into the number of years into your pension value. And they say you got to take the first year around 73, it's about 4%. So, it'd be 4,000 out of every 100,000 you have to take out and pay tax on. So is there a good reason to start now at 69, start reducing that now so the RMD is less? Generally, I don't think so, unless your years before that are low income years. Like I've had clients that had zero income because they have plenty of money invested, but they could take it out of savings, which isn't taxable at all, or out of a post-tax account. And I say, hey, go ahead and take some, because you could take 30,000 and pay zero tax because of the standard deduction. So there are times you definitely want to take out because you got the deduction when you put it in, and you're now paying zero or low tax taking it out, and that's called arbitrage, and that's the goal of investing in traditional IRAs. So again, very person specific, but there's your answer on that.
Okay, thank you, Mike. Most of my money in pre-tax accounts. Should I roll out to Roth?
Well, that was what I talked about earlier, and it depends to test your mettle, whether you're willing to pay a lot of tax to move it over. But again, there's modeling software that could say whether you should do it or not. And if they're low income years, you should definitely do it. Roll it out, pay a little tax on it. It earns tax free. You take it out later on tax free.
Okay, thank you, Mike. Next question is, should I give properties to my kids?
Gifting, great question. Get it all the time. Generally speaking, this is the general rule, and then you vary from that. Gifting is bad, inheritance is good. I didn't say dying is good. I said inheritance is good. Okay. So the point is if I gift a home, let's say I have a vacation home in my home, and I'm getting nervous, I'm getting older, I just want it out of my name. Okay. Maybe for medical reasons, for whatever. And I say, okay, daughter, I'm going to gift you this home. Well, if I bought that home for $200,000, it's now worth $800,000, right? If I were to sell it, I'm going to have a $600,000 gain on the vacation, pay tax, maybe $200,000. Okay. I give it to my daughter. She takes my place on a gift. She now has a $200,000 basis and $800,000 value. And if she sells it, she's going to pay tax on $600,000. Well, you say, Mike, that's fine. You're going to, but what if Mike dies? He does that triathlon and falls off the bike and hits his head and he dies. Well, there's a step up in basis. My daughter will get that at $800,000 basis because it steps up to the value. Now, if she sells it after I die, zero tax. So in general, inheriting property and assets is better than gifting them for tax purposes. Now, not 100% of the time, because sometimes there is Medi-Cal and medical issues that will change that, or there's blended family issues that you want to solve. There's all sorts of reasons why you still might want to do it, but generally it's better to just put the property in a trust, have the right person going to inherit it, and then they get it. Now, if the child needs money and they need property, gift them money that doesn't have a gain in it, regular money, something like that. That way you're not gifting away gain. So generally no, but remember you can give away 18, I think it's 19,000 a year without filling out any forms, and the child doesn't pay any tax on it, or the recipient, and the payor doesn't pay any tax or deduct it, and it's just a transfer of assets. You can do that as many people as you want. You can 10 different people, you can give them 19,000 each. Your spouse can give 19,000 each. So sometimes they get the question, oh, my daughter needs X dollars to, she's married, to buy a house. I want to give her some down payment money. Well, I can give the daughter 19,000. My spouse can give the daughter 19,000. I can give the spouse's, the daughter's spouse 19,000. And so you can do 4 times 19 without reporting it anywhere. Once you go over that amount, you start digging into your $15 million exclusion. Big deal. My estate's not worth $15 million, but you got to file some forms called 709. Sorry, that was a long answer. And we're at 6:40. So are there many more questions? Because I want to let people go.
I think we have few questions, Mike, but it looks like they're very specific to the person they're asking. So we know who they are, and I feel maybe you can address it personally after the webinar.
Well, wonderful. Well, thank you for sharing the evening with me. You can see I'm very passionate about this subject, and I hope you are too. And I appreciate you. And be sure to refer this to any family members so that everyone, I want the word out so that everyone plans and everyone's successful retirement. Okay. Have a great evening.
Thank you.
Bye.
Bye.